Welcome to TradeX Pro. Whether you're new to trading or a seasoned pro, you're in the right place. In today's video, we're diving into one of the most essential tools in a trader's arsenal, the Relative Strength Index, or RSI. This powerful indicator helps us measure the momentum behind price movements and identify potential entry and exit points in the market. This series will unfold across 3 engaging episodes. In the first episode, we'll lay the groundwork by introducing the basics of RSI and exploring some foundational strategies that can enhance your trading decisions. In the second episode, we'll elevate your understanding by diving into RSI divergence, an advanced strategy focused on identifying fading momentum, which can be a powerful signal for potential reversals. Finally, in our third episode, we'll delve into RSI hidden divergence, a technique geared toward trend continuation. Mastering this concept will help you stay ahead of the market and confidently ride those trends. Let's start by defining RSI. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. It helps traders evaluate the strength of recent price action. When there are rapid price rises, the RSI will be high, reflecting strong momentum and indicating that the price is relatively strong. Conversely, when there are rapid price falls, the RSI will be low, showing that the price is relatively weak and could be due for a reversal. The RSI ranges from 0 to 100, where values close to 0 indicate weak momentum and values close to 100 indicate strong momentum. In the charts below, we can see how the Relative Strength Index interacts with price movements. The blue lines represent the price, while the yellow lines indicate the RSI. When the price rises continuously, notice how the RSI remains relatively high. This reflects the strong upward momentum of the price. Similarly, when the price rises rapidly, the RSI also shows high values, confirming the strength of the upward movement. Conversely, when the price falls rapidly, the RSI will drop and be relatively low. This indicates weak momentum and reflects the downward pressure on the price. Additionally, if the price has been declining over a prolonged period, the RSI will generally remain low, showing that the overall momentum is weak. Now, let's explore how the candlestick chart works alongside the RSI. In this chart, the dashed lines near the RSI chart divide the RSI into 3 distinct zones. The strong zone is above the top line, indicating strong momentum. The moderate zone is between the 2 lines, reflecting balanced momentum. The weak zone is below the bottom line, showing weak momentum. These zones help you interpret the strength of price movements more effectively. When the price rises rapidly, the RSI climbs into the strong zone, reflecting powerful momentum. Conversely, when the price falls quickly, the RSI drops into the weak zone, signaling diminished momentum. Please be aware that if the price rises steadily but not rapidly, the RSI may remain in the moderate zone. This happens because the RSI measures both the speed and strength of price movements, so a steady rise without rapid increases may not push the RSI into the strong zone. Here's what this looks like in practice. Initially, the price rises rapidly, pushing the RSI into the strong zone. After a brief pullback, the price climbs again but at a slower pace, evident from the gentler slope on the chart. Although the price reaches a new high, the RSI remains in the moderate zone, signaling a slowdown in momentum despite the higher peak. This happens because the RSI reflects not just the level of price movement but also its speed. A slower rate of increase after a rapid rise results in a moderate RSI, showing that momentum is weakening despite higher prices. Traders usually use 3 key levels for RSI: 30, 50, and 70. When RSI is equal to 50, which is the midpoint of its range, it indicates that the momentum is neutral, with neither bullish nor bearish pressure dominating the price movement. We normally use a dashed line to illustrate this value on the RSI chart. Now, if we examine the chart carefully, we can divide it into 2 parts. On the left side, RSI is generally below 50, as shown by the red shading. This indicates that the price is relatively weak and in a downtrend. On the other hand, on the right side of the chart, RSI is above 50, highlighted by green shading, suggesting that the price is relatively strong and experiencing an uptrend. Traders often use the 50 line to separate an uptrend from a downtrend, with the line serving as a key indicator of momentum shifts. Next, let's add two more lines to the RSI chart. Above the top line, the price is considered too strong when the RSI is above 70. Below the bottom line, the price is considered too weak when the RSI is below 30. These levels help identify potential extreme conditions in the market. Generally, traders refer to the region above 70 as overbought and the region below 30 as oversold. This terminology reflects market conditions where prices have moved significantly beyond their typical range. When the RSI is below 30, it indicates that the asset may have been sold off too aggressively, possibly setting the stage for a price rebound. Conversely, when the RSI is above 70, it suggests that the asset may have been bought excessively, potentially leading to a price pullback. These labels help traders identify potential turning points in the market. That wraps up our introduction to RSI. In the next section, we'll dive into strategies for using RSI effectively. Please note that these strategies focus solely on the RSI indicator itself and do not cover how to combine RSI with other indicators. Traders often pair RSI with additional tools to enhance their trading opportunities and accuracy. Here are the strategies we'll cover: overbought and oversold, pullback to 50, pullback to key level, trendline break, moving average crossover, RSI divergence, and RSI hidden divergence. In this episode, we will focus on the first 5 strategies, exploring how to effectively use these RSI techniques to enhance your trading approach. Let's begin with the first strategy: overbought and oversold. In the example below, when the RSI reaches the oversold zone, it indicates that the price is relatively cheap due to a prolonged or rapid sell-off. Traders might see this as an opportunity to buy, anticipating a potential reversal and upward movement in the price. On the other hand, when the price reaches the overbought zone, it suggests that the price is considerably high. Sellers might see this as an opportunity to sell and take profits. As a result, the price might be poised for a reversal and decline. Traders can apply this strategy in a ranging market by watching for the RSI to enter the oversold zone as a signal to buy. Conversely, they should look for the RSI to reach the overbought zone as a signal to sell. This approach leverages the RSI to identify potential reversal points within the range. Please note that we do not usually enter a position immediately when RSI enters either zone. Instead, we wait for the RSI to exit the oversold or overbought zone before executing the trade. This approach helps to confirm the potential reversal and reduce the risk of false signals. In this example, we observe the oversold zone highlighted in green. When RSI first enters this zone, the price is weak and still falling. We should hold off on executing any trades at this point. Once the RSI exits the oversold zone, indicating that the price is starting to strengthen, there is a better chance of a price rebound. This is the moment to consider buying. Similarly, this example illustrates the same market behavior. We have an oversold zone highlighted. When the price enters this zone, it indicates that the market is experiencing a significant sell-off, and the price is quite weak. As we observe, it's important to refrain from taking immediate action. Instead, we wait for the RSI to exit the oversold zone, signaling that the price is beginning to recover and gain strength. Only then should we consider entering a trade. The idea is the same for an overbought condition. When the RSI enters the overbought zone highlighted in red, it suggests that the price is excessively high and might be due for a pullback. As with the oversold scenario, it's best to wait until the RSI exits the overbought zone before making a trade. This approach ensures that the price has confirmed a potential reversal and is showing signs of weakening. This example clearly supports why we should definitely wait. As shown by the red shading, the RSI has entered and stayed in the overbought region for a prolonged period. If we had sold the asset at the initial overbought signal, we would have missed out on additional profits due to the continued price rise. Instead, by waiting for the RSI to exit the overbought zone, we ensure that we capture a more accurate signal of a potential price reversal and avoid premature exits. This is also the perfect spot to consider a short trade, capitalizing on the potential price reversal. Based on prior examples, this strategy might seem effective, but it has its drawbacks. During a prolonged uptrend, for instance, the RSI can remain in the overbought zone for an extended period. While our usual approach suggests selling or making a short trade when RSI is in this zone, doing so during a strong trend might put us in a losing position. This false signal highlights that the strategy can be less effective in trending markets. Traders should utilize this strategy primarily in range-bound or sideways markets, where the price oscillates between established support and resistance levels. In these conditions, the overbought and oversold signals from RSI can help identify potential reversal points and provide valuable trading opportunities. Next, strategy number 2, pull back to 50. In this strategy, we focus on the 50 line as a key point of interest. During a long uptrend, the RSI typically remains above this line. When there is a minor pullback or brief consolidation, the RSI may drop slightly towards the 50 line. If the RSI holds at this level and then rebounds, it suggests that the price remains strong. This is a prime opportunity to buy, as the price is likely to continue rising, supported by ongoing momentum. Traders may choose to wait until the price makes a new high after the pullback and the RSI bounces back up to enter the trade. This approach confirms that the price momentum is strong and provides a more reliable signal for buying. Another example illustrates a similar scenario. The RSI 50 line is our reference point. As the price continues to rise, it experiences several minor pullbacks. Each pullback causes the RSI to drop slightly, but if the RSI holds above the 50 line, it indicates that the price is likely to continue its upward movement. We can find multiple opportunities to enter the trade as the price makes new highs, confirming the ongoing strength of the trend. In a prolonged downtrend, we need to switch up our approach. The RSI often stays below the 50 line, highlighting bearish momentum. When the price pulls back or pauses, the RSI edges toward the 50 line, indicating a possible slowdown. However, if the RSI reverses direction and drops back down, it signals that the downtrend is likely to continue. Traders might then take this chance to enter a short trade as the price makes a new low, capitalizing on the ongoing downward momentum. In this example, there are opportunities for both buying and shorting. On the left, the market is in an uptrend. The price initially rises, then undergoes a minor pullback. During this pullback, the RSI dips toward the 50 line. If the RSI remains above this level, traders might consider buying the asset once the price makes a new high, signaling the continuation of the uptrend. After some time, the trend takes a turn, with the RSI crossing from above to below the 50 line. This shift marks our transition from uptrend to downtrend trading. In this new setup, we watch for the price to pull back during the downtrend. If the RSI hits the 50 line and then reverses downward, it's our signal to act. Traders might jump in with a short trade as soon as the price breaks to a new low, aiming to capitalize on the fresh wave of selling pressure. Our next strategy follows a similar approach to the previous one, but with a twist. Instead of using the RSI at 50 as our reference point, we look for other values that represent key levels. In this example, we see a steady downtrend with several pullbacks along the way. Each pullback is marked by the RSI rising to a certain level, not necessarily at the 50 line, but somewhere nearby. Traders can use this level as a key indicator and wait for the RSI to bounce back down. When the bounce suggests a continuation of bearish momentum, traders might enter a short position, anticipating further price declines. If the RSI returns to this key level, the strategy can be applied again, taking advantage of repeated opportunities in the downtrend. Similarly, this example shows a downtrend market with pullbacks. The RSI remains below the 50 line most of the time, confirming the bearish trend. At the peak of each pullback, the RSI rises to a specific level known as the key level. If the price returns to this key level and then bounces back down, traders might consider entering the market, expecting further declines. Our strategy also applies in a bullish market. We aim to enter positions during pullbacks with solid confirmation. During these pullbacks, the RSI falls below the 50 line and then pauses at a key level. If the RSI holds at this level and begins to bounce back up, traders can consider entering the market, anticipating that the price will rise. Our fourth strategy involves drawing a trend line on the RSI. Unlike the previous strategies, this approach is primarily used as an exit signal. By monitoring the RSI trend line, traders can identify potential points to exit their trades based on changes in momentum. The trend line on the RSI can be drawn using the same method as for the price trend line. In a bullish market, the RSI will typically rise along with the market. Connect as many lows as possible to draw this trend line. If the market starts to lose momentum, the RSI will show signs of weakening. Traders should wait for the trend line to break and close their position. This approach helps secure the profits made. In the same example, if we re-enter the position after securing profits from the previous trade, and we observe the RSI increasing again, we would follow the same approach. We would wait for signs of weakening in the RSI to indicate a potential loss of momentum. Once we detect this weakening, we can prepare to exit the position, securing additional profits and managing risk effectively. The strategy can be used for the downtrend market as well. In a bearish market, the RSI will generally decline along with the market. Draw the trend line by connecting as many highs as possible. If the RSI breaks above this trend line while strengthening, meaning the RSI is rising despite the overall downtrend, it may indicate that bearish momentum is weakening or that a reversal could be near. Traders should consider closing their short positions to secure profits and manage risk effectively, as the downtrend might be losing its strength. Sometimes the downtrend can last for extended periods, such as several months. In these cases, we can still use the same strategy. Begin by drawing a trend line on the RSI, connecting as many relevant highs as possible. Continue to monitor the RSI for signs of strengthening. If the RSI breaks above the trend line, we should consider closing our short positions to lock in profits and safeguard our gains. The last RSI strategy we are covering today is the moving average crossover. Notice that on the chart there is an extra line overlapping the RSI. The yellow line represents the standard RSI with a period of 14 candles, while the blue line represents a moving average of the RSI. This moving average smooths out the RSI values over a set period and reacts more slowly to price changes. This helps reduce noise, highlights the underlying trend, and serves as a signal line to identify potential changes in momentum. When the RSI crosses above the moving average, it may signal a bullish opportunity. Conversely, when the RSI crosses below the moving average, it could indicate a bearish signal. In this example, the RSI crosses above the moving average when its value is below 50, suggesting a potential upward move in the stock price. We wait for the RSI to move above the 50 line to confirm the uptrend before entering a buy position. When the RSI is above 50 and crosses below the moving average, it indicates a potential shift from bullish to bearish momentum due to increased selling pressure. We then wait for the RSI to drop below the 50 line to confirm the downtrend. Only after this confirmation do we consider selling the stock. In another scenario, we observe an RSI crossover in the weak zone, suggesting a potential shift to an uptrend. Once the RSI crosses above the 50 line and breaks out to the top, we enter the position. We then wait for a sell signal to emerge. When the RSI crosses below both the moving average and the 50 line, we exit the position to secure our profits. Our last example for today's episode features a combined strategy. On the chart, we observe a prolonged downtrend market. We start by noting the RSI crossovers to the left. To enter a short position, we wait for the RSI to cross below the 50 line. Throughout the downtrend, there will be multiple pullbacks and pauses in price, resulting in several RSI crossovers. However, we hold off on covering our short position until the RSI crosses above the 50 line. Despite several attempts by the RSI to move up and then bouncing back down, we finally see an RSI crossover coupled with the RSI breaking above the 50 line. At this point, we exit the position and cover our short. That wraps up today's episode. We've introduced the Relative Strength Index and explored 5 fundamental RSI strategies to enhance your trading toolkit. In our next episode, we'll dive into RSI divergence, a powerful tool for identifying potential reversals in the market. Stay tuned as we uncover how to leverage this advanced strategy to refine your trading approach. Thanks for watching, and see you next time.